Good afternoon, everyone. This is Fran Radano, one of the managers of North American Income Trust, here to talk to you about the trust itself. It's a little bit different. It's not the Mag 7. It's not dominated by, a small handful of companies. It's a really nice, well-diversified portfolio. And today we'll meet the manager, myself. I'll talk about the team. We'll talk about North American equities, and we'll just sort of show you, why we're a little bit different and why we're a bit unique. And I think we're very well positioned going forward. Next slide, please. So there's a lot going on in this slide, but this sort of gives you sort of that high view here. I think what's most important is that this is very much a best ideas, we'll call it 50 stock portfolio of high cash generative companies. The average dividend, and we know that the US isn't known for paying high dividends, but the average dividend in this trust is roughly 3%. The dividend growth, which is equally important for us. This isn't just a bond proxy portfolio, but a dividend growth portfolio. So the average dividend growth in this portfolio, we're expecting to be 6 to 7%. Historically, it's been around that range, if not a little bit higher. But we expect that growth to continue into 2026. And we also have revenue reserves of well over a year. So the income component is well vetted. We also think the growth is very important here. So this isn't just a bond proxy. This isn't just a high income portfolio of the highest yielding stocks, but a combination of both growth and income. Next slide, please. And here's a picture of myself. Luckily, I'm not wearing the same tie, but myself and Jeremiah here at Janus. And just so you know, we're the managers of the fund. The buck stops with us, but to be sure, we have a tremendous research team, which I'll talk about a little bit later. Really, boots on the ground. I'm, in Denver, and they're often not in the office. They're often out here meeting with companies, meeting with competitors, meeting with anyone that can help them understand a story better. So we will talk about that, but we do the hard work here, and the focus is on high quality companies. This isn't a trading portfolio, but high quality companies that theoretically we can own indefinitely. That are both a combination of growth and income. Next slide, please. And this is a little bit of who we are. I think most of you are probably well aware of the Henderson side of Janus Henderson. You may be less aware of Janus, and Janus is Denver based. It's been around for quite some time. And importantly, and maybe this isn't fully appreciated, but Janus has a best-in-class investment team here in Denver. This stacks up with any of the big names you've heard about in the U.S. Incredible depth, and you see it. And I laugh. The research team is on the bottom right. They should probably be in the middle. You have a group of analysts, and many of them can be career analysts. There's a full path for a career analyst, which is tremendous as a portfolio manager to have someone that has seen the great financial crisis, has seen Y2K, and obviously we lived through the period of the pandemic. But that's important. We have a great risk team that sort of, gives us sort of keeps us in our lane, so to speak. This isn't, a gunslinger portfolio by any means. It's actually quite simple and straightforward. And the trading desk is also terrific with great execution and very helpful two-way flow when needed. Next slide, please. And here's how the trust works, as the title is. It's a diversified trust, and the yellow bar is our current exposures. And the turnover in this portfolio is very modest. It's 25 to say 50%. And when there's opportunities arise, we're ready to buy or sell as needed. But again, we're looking for companies that we can hold for the long term, and we don't buy a company thinking we're going to hold it for 6 months and then sell it. It's very much we're going to hold this indefinitely. But as we know, things are never static, and in a dynamic world, there's always opportunities, and there's also re-ratings and de-ratings where we can be more opportunistic. But needless to say, it's a well-diversified portfolio across all sectors. And if you look in the far right, materials, we currently have no holdings in the materials sector, where we find the companies they're either overvalued or just not interesting to us from a quality perspective. And then financials and healthcare, two of our bigger positions here. And at the highest level, what we like about financials, and it's not just banks, it's a very diverse group of companies. But what we like here is in the US, there was a period of heavy regulation coming out of the great financial crisis. And in the last year or two, some of that onerous regulation has been cut back to more sensible, sort of market favorable regulation. So I think the regulatory environment is going to free up a lot of capital, a lot of investment. And I think the financial companies are very well positioned here and still trade at very modest multiples. And then healthcare, what we like about healthcare is it's sort of a combination of offense and defense. You have that baby boomer generation that are the heavier users of healthcare coming through. So there's a good bit of volume coming through. And then, from a defensive perspective, it's very consistent, very predictable growth. So when we model these companies, it's generally fairly straightforward. And then technology, I would obviously be hasten not to talk about that, but it's roughly 10 to 12% of our portfolio over the last several months. So we have a good mix of technology companies, but this isn't a tech heavy 50% technology type portfolio, but again, a very good diverse mix of companies. Next slide, please. Why North American equities? I think that many of you are aware of sort of the bullet points on the left, sort of the importance of that. I think what I mentioned earlier was the deregulatory environment here is becoming more balanced, if you will, from over regulation to something proper regulation. And I think something else that may be underappreciated is a recent fiscal bill that sort of changed the game for corporates where they can expense capital expenditures and R&D, because what I've heard over the past several years is the US companies don't invest in their business, they just buy back stock. And I think that's a very big misnomer of the U.S. market. I can show you 50 companies in our portfolio that do a lot more. They invest in the business, they pay a proper dividend, and if they have any surplus funds, they may or may not buy back a little bit of stock. But again, very well balanced, and we feel very good about the portfolio here. The top 10 active positions there toward the right there, the right center. I would tell you that our top 20 positions are typically over 60% of the portfolio. So it is a very high conviction portfolio. And then overall, we have about 50 stocks. And then here we have the top yielders. And it's 4 to roughly 7.5% on the top yielders. And every stock in the portfolio does have a yield. All but one of our stocks raised their dividend last year, and average dividend growth last year was in excess of 7% in this portfolio. Next slide, please. So this slide, it's a little bit busy, but the blue bar toward the top there is the U.S. market. The U.S. isn't a high dividend market, as you may know. What we think was, again, we found 50 stocks that we think fit the remit nicely. But what's important here is it's a dividend growth market, which we think is very important. So dividend growth tends to trend with earnings, and what we see is a consistent growth rate there. And then to bring it home to the North American Income Trust, over the 15 years of the trust since it was converted, we only had one dividend cut, and that was during the pandemic. So during the pandemic, we had one small dividend cut. We still own that company. We like that company a lot. And the dividend rate there is actually considerably higher than it was prior to that cut in 2020. So continued dividend growth, very predictable. Our analysts model the dividends here. The dividends are paid out quarterly to shareholders. And again, very predictable dividend growth. And we already have a good feeling already this year what we expect that dividend revenue to be over the course of the year. Next slide, please. Why North American equities? I think we know the innovation. We know the companies that are coming out of the U.S. They're obviously very well-known global entities. The biggest areas you see beyond technology, you see it in healthcare, you see it in a lot of the industrial companies. But I would also tell you that some of this innovation and some of the productivity we're seeing from AI and from other means are now bleeding into the rest of the portfolio. So banks are using this, consumer companies are using this, even sort of more staid industries like in energy that is obviously heavy asset intensive can use some of this technology. So you see the productivity, you see the operating leverage of these businesses once they get hold of these tools. And I think it really sets up a good period looking forward for US companies. Next slide, please. And this is just sort of North American income from a big picture perspective. Roughly 83% of companies in the S&P 500 raised their dividends last year. For us, it was 49 out of 50. And the one company that didn't was in the middle of an acquisition, and they sort of were delevering the balance sheet back to a normal level. So we expect that company to raise their dividends. So we expect dividend growth. And then that 8.7 number for the U.S. market, that's a little bit higher than our average. That is a bit flattened by some of these Mag 7 or some of these very big stocks in the benchmark that have very small dividends that may double them, sort of skews the numbers there. But needless to say, and I've said it several times already, but the dividend growth in this portfolio, we're modeling between 6 and 7% for this year. And then GDP, GDP has grown roughly double the G7. We had a GDP print today for the U.S. of 2% for Q1. We very much expect that to continue that GDP growth. Next slide, please. And this is an interesting one. This just shows a little bit of what we're seeing in the market that may not be fully appreciated by investors. But the Magnificent Seven, I have nothing bad to say about them. They're terrific companies. They've done very well. They have strong moats. They've had great earnings growth the past few years. What you're starting to see is an earnings normalization here. So the yellow bar of the Mag 7, that by the end of the year, and these are consensus estimates, we actually see the Mag 7 earnings growth beginning to normalize with the market, and the market being that those 493, those blue bars, which is somewhat representative of the North American Income Trust. We think we have a better subset of that. But needless to say, you see a broader market, you see something that's a little more equal from an earnings growth, and what it's just a healthier market when you see not seven companies dragging the entire earnings of a market, but something more broadly. And again, as I mentioned earlier, things like AI being pervasive in other sectors beyond technology, that's part of the productivity loop here. And that's something that's going to be very important for the market. Again, not just this year, but as we look out to the rest of the decade. Next slide, please. Where does NAIT fit? We can talk about that, but I think it's an interesting one because if you were to hold a S&P tracker, that's dominated by the very biggest companies. If you were to hold an equal weighted S&P fund, that's perfectly fine too. Ours is, we think we found the best 50 stocks that sort of have that combination of growth and income. So I think it's a bit unique. It's a nice cornerstone. We've grown our dividends at a 7% CAGR since 2012, and we continue to do that. I mentioned the revenue reserves are over a year. So we expect those quarterly dividend payments to continue and pay a progressive dividend. And these dividends are also covered. This is not an uncovered dividend portfolio. So this is a very healthy revenue generative group of companies, and that revenue that comes through to us is then forwarded on to shareholders in the form of quarterly dividend payments. So we think it's a nice fit. It complements, whether it's a UK or sort of a global centric equity income. If that's a style of investments that you prefer, this would sort of round out that type of portfolio. And here's performance. Obviously this is public information. You can see the share price, the NAV, and then the Russell value is our benchmark. It would be the traditional equity income benchmark. We also have a sort of another reference benchmark, which is the S&P High Yield Dividend Aristocrats, which is a bit less known. But again, we're looking for companies that are dividend payers, proper dividend payers. And for us specifically in our 50 stocks, we're looking for dividend growth as well. And that's it. That is the glossary if needed. But plenty of time for questions, and I look forward to answering them. Thank you.
Thank you, Fran. Let's see if we've got any questions. Just let me click on the thing. It kind of took me by surprise there. I was kind of sort of thinking about what you were telling me rather than paying attention to the time. Yeah, none coming through from the audience yet, but please do keep typing away. I'd scribbled one or two things down while I was listening to you there. Your discount has gone from, being a discount to now being a slight premium, I think, hasn't it? And it seems to be out of line with historical discount levels for the trust over the last sort of 5-10 years. Could you talk me through that, how that's happened, why you think that is? If you know.
I always wonder, when what I try to do and what Jeremiah and I try to do is we try to manage to optimize the NAV.
Yeah,
we think over time the discount will work out, but obviously there's some dynamics there. There's some technicals probably in there. But the shareholder reception's been great. I mean, I've done a lot of marketing the past few months. I've been in all across the UK, up and down, up through Scotland, out west, and the reception's been good. I think people are looking for an alternative. They see the market broadening. I showed a slide of the market broadening, and maybe people don't know the exact numbers, but they know that there's something more than the Mag 7, and the Mag 7 has had a good run. So maybe, let's see, is there a vehicle where we can get, sort of a broader swath of companies that aren't the top 5 companies in the S&P? and I think the reception's been pretty good. It's we've had a lot of good conversations. Sometimes they're debates, and valuation's always been a governor in the US. I mean, valuations are 22, 23 times forward earnings. In this portfolio, it's been between 16 and 17 times. So that
Right.
doesn't guarantee downside protection absolute, but it does show that what we're looking for, we're not looking for the cheapest companies, we're not looking for the highest yielding companies, but sort of fairly valued, high quality compounders that have that cash generation. Because anyone
Mm,
can sort of there's an old saying that earnings is an opinion, cash is a fact.
mm,
And when we see those high quality cash flows, and to be sure, we're not looking for the cash flows that just pay the highest dividends. We want them to invest in the company first. Dividends are secondary, if not tertiary. But these companies understand, they focus on their capital expenditures and then give the shareholders back surplus funds, and don't try to find the 12th most important project, because that tends
mm,
to be a low return on investment opportunity.
Okay, thank you. Just a quick question. I must have misheard, but I thought you said at one point your turnover in the portfolio is between 25 and 50%. Is that
Yes.
right?
Yes.
That sounds quite high when you're talking about buy and hold kind of approaches.
So what I would tell you is 25% feels like the normal baseline. And then when you
Yeah.
looked at periods like Liberation Day, the
Yeah.
colloquially, or you look at periods, like the start of the Iran war, or the government shutdown. So when the market dislocates, we will trade a little. If there's opportunities there, it's the old, you talk to your analyst, if we have a blank sheet of paper, what stocks would we own in this portfolio? And if we own something that has done well, or something that hasn't, that's sort of we will be willing to make those decisions. And I would also tell you, when you look at that turnover over time, most of it is names that have done well within the portfolio, top slicing a bit, names that have underperformed where we feel high conviction topping up. So it's not a wholesale change of names in the portfolio. Those tend to be fairly steady. It's more a little bit portfolio management, sort of around the edges, and just sort of, working our conviction and making sure that the top 10, top 20, our biggest weights are the right weights at any given
hmm
time.
hmm Yeah. Do you have a sort of a maximum percentage of portfolio that you can allow any individual holding to reach? And
Yeah, generally it's been around 5%. There is a hard fast rule that's much higher, 10%.
yeah,
But Chevron's our biggest portfolio name here. We actually consolidated our energy holdings last year, and Chevron has a little bit of that offense and defense, when compared to the rest of the energy. But what I would also tell you is Exxon's a big part of the benchmark weight. So for us to make a true position in the big integrated oil companies, of which there are two, Chevron and Exxon, we needed to be a little bit above size on that. So it wasn't a bet on oil going to 100. But again, we're prepared for that in this portfolio.
Okay, okay. Oh, we've got some coming through here. So, questions from the audience rather than listening to me all day. Do you think NAIT offers any defense if the AI bubble bursts? Because I guess if it does
Yeah,
burst, it's going to
yeah,
have a
yeah.
knock-on effect as well. I don't know how
Yeah.
robust your portfolio might be if that happened.
Yeah, so I think with the AI, and the phrase bubble, it's a tricky one, because it's some people would agree, some people wouldn't agree. There's a lot of what we can all agree on is there is a lot of capital going toward AI. And most of the companies in this portfolio are beneficiaries of that capital. But we also have companies like Eaton that are part of the data center build. So, we do have exposure to that data center build, which is part of the growth component of our portfolio. But then,
Yeah,
I mentioned some financial companies that are using AI very aggressively to lower their cost base and be more productive. And so, we see some of that. But, we're not in the hyperscalers. We're not looking for that type of portfolio. Um, so for us, it's trying to find that threading that needle between growth, income, and then proper valuation, paying the right price for companies. We can
yeah,
all find great companies trading at 40 times, but for us, we're trying to find very good, high quality companies trading at fair prices.
yeah. Understood. But what share have you held for the longest, and as a matter of interest, and why? Jason is asking.
So this fund was converted from a tracker in 2012, and I would probably tell you that since 2012, there's a lot of the stocks in the fund have been held for the duration. So,
Mm,
we have some core holdings, and then some of them, like a company like JP Morgan, we don't own right now. But that's a name we've held, and when we have to, what I say to the team when we have to pay the Jamie Dimon tax and pay 3 times book for a company, is that the best use of capital? Again, tremendous company, great compounder. We may own it in the future, but we want to pay a fair price. So what we do is we own a company like PNC, which is a tremendous sort of super regional bank, and then we own Morgan Stanley, which has the investment bank component. And for us, I wouldn't call it a synthetic JP Morgan, but we think we've sort of have the capital market exposure with JP Morgan, the banking with PNC, and we sort of get what we believe is a better risk-adjusted portfolio over time. So that would just be
Okay.
one example.
Okay, thank you. David's asking here, how much alignment with other Janus funds, I guess the ones that we have available to us in the UK,
Yep.
e.g. collective buys and collective sells, is there?
Not a lot. There is some overlap, but it's this as I mentioned earlier, this is a Russell value. So if you think of the Morningstar boxes, this fits somewhere between a large value and a large core box. The flagship product here is the Janus Balanced Fund, which is a large cap core product. But as you know, the core product is benchmarked against the S&P. The S&P I would sort of half joke as a growth benchmark, even though by definition it's the market. So
Mm,
we
mm,
skew a bit to the value side of that. So there is some overlap, but this is not this is very different from most of the Janus funds that you may see elsewhere on different
mm.
platforms.
Okay, thank you. Um, I mean, we talked a little bit about the potential for the bubble to burst in terms of AI. I mean, the whole macroeconomic situation at the moment looks a bit sort of precarious with the Iranian war sort of lingering now, and nobody's quite sure what that impact is going to have on oil prices and availability of all sorts of commodities. Um, have you done a lot of sort of scenario planning on that and sort of looking at your
Yeah.
portfolio in a wider sense of as to what outcomes you might see in the next few
Yep.
months?
Yeah, no, we did this at Liberation Day last year. We've done it with here and oil prices being the key caveat because we do have energy companies, but we also we have a small position in a cruise operator called Royal Caribbean, and as you can imagine, fuel's a big component of theirs.
Mm,
They're 60% hedged for this year, but longer term, if oil's 100, for an indefinite period of time, that does change the economics. So we do talk about this all the time. And again, it's not just sector by sector. If oil prices are elevated, you'll see the inflationary knock on across the entire portfolio. So it's
mm,
something we
mm,
always need to think about. And it all comes back to Chevron is a de facto energy hedge, and we sort of get the benefit there. And when we think about dividend payments longer term, we think of dividend payments as outpacing inflation, especially in this portfolio. So it's something that we think about, but from a bottoms up perspective, very much so. I mean, we do analysis of scenarios all the time, not
mm,
when the war, the government shut down, but it's obviously done beforehand. We know our risk controls. I mentioned our risk team earlier. We get monthly readouts of all our risks. So if we make some changes in the portfolio, did we create an unintended consequence? Did we, make a bigger bet on interest rates that we didn't really want to make? Those are the things that
mm.
we were looking
Yeah.
at and the data that we have to sort of optimize the portfolio from a construction basis.
Mm. Now, correct me if I'm wrong, but I think you also have the option to go into fixed income
We
up to a
do.
certain percent, don't you?
We do. And we've not used that. Historically, we've used that between 0 and 5% over the last 10 years. Since the trust moved to Janus, roughly 2 years ago, we've gotten rid of that component and simply just kept it in equities. And what we have is a little bit more of a defensive equities tilt. So if you were to look at beta, and beta is not a perfect measure of portfolio volatility, but our beta has roughly been plus or minus 0.95, so a bit less than the market on the whole. And that's sort of how we think about things from a big picture perspective.
Okay. So as far as you're concerned, there's no scenario that would drive you towards fixed income as you still got that option, I presume,
We
have you
still
in
have the
the
option. We could
yeah,
still do that.
okay.
And what we would probably be more apt to do is just find more defensive sectors or more defensive stocks within certain sectors, which is sort of the case, right now, quite, admittedly.
Okay, thank you. Got another question here from Nat. How do you view the US oil refiners? I mean, you touched on Exxon
Yep.
and Chevron there. Do
Yep.
you want to go into a little bit more detail about that?
Yeah, we do. So Exxon and Chevron both have some refinery exposure. It's not the biggest component of their earnings. We did own a company, Phillips 66, um, that sort of, and I mentioned earlier, we consolidated our energy holdings. We own Phillips 66. An activist came in, um, made a pretty aggressive pitch on why the stock should be considerably higher. The stock did move a bit, and we just sort of sold into that because we thought some of the decisions there were some government governance issues. There was two members on new members on the board that sort of had a different thought process than the legacy members, for better or worse. Um, the refining business is doing quite well right now. When things dislocate over time, it's a difficult business. So it's one of those where Chevron is sort of, Chevron's almost like owning three or four energy stocks into one. And that's how we
Mm,
would view that. And we decided, over a year ago that that was a better use of capital than owning Phillips 66 plus Chevron. We increased our Chevron position a bit. So refining, it's an interesting subsector. It's an important one, especially going forward. If Venezuela oil becomes more relevant, if Alaskan oil becomes more relevant, and Middle East
yeah.
oil. So that's sort of the answer. But we could always go back in refining, but we feel very comfortable with our Chevron position right now.
Okay, thank you. I was also going to ask you, gearing
Yeah.
wise, I presume you've got you do gear it from time
Yep.
to time. What kind of gearing level have you got at the moment?
Yeah. So we have an interesting gearing philosophy here. We are James Ferguson, our former chair, in 2020 during COVID. He was also the chair of Monks, and Monks had just done a big refinancing, and he brought it to the NAIT board of let's consider a refinancing of our accordion. And what we did is we found great, cheap, sub 3% money that went out 10 and 15 years. And so we locked in $50 million US. So we are sort of that is fully invested. So we are structurally geared roughly 7%. So when I think of the portfolio, the equity exposure may be, 104, 105%. We may have a point or two of residual cash. And then, as I mentioned earlier, the beta of the portfolio was roughly 0.95 plus or minus over time. So when you sort of gear adjust the beta, we're getting a full market portfolio. So when our risk team shows the beta with the gearing, it generally hovers right over 1.0. So you're getting full market exposure. We have cheap gearing, sub 3%, and it is fully invested.
Okay, okay, thank you. Um, and I mean, now you're at a premium. Do you think the board? I know it's not your call, but do you think the board are going to issue any new shares in the near
Yeah,
future?
I think the board's open to that. I think, we want to see it get to a sustainable level versus, the
Hmm.
day it gets over 100, and the discount, the discount mechanism has been pretty strong. Our fiscal year just ended in January, and we bought back 7% of the company last year at discounts in that sort of mid to high single digit range. And the year
Hmm.
before, we bought back 10% of the company. So, we will defend the discount. But being, in and around the premium right now is theoretically the opportunity to make the trust a little bit bigger and to take some of that. So I think that would be, under full consideration.
Okay, and I can't let you go without mentioning Saba.
Uh-huh.
Um, you're probably aware of the kind of actions
Yep.
going on in the UK market with investment trusts and Saba
Yep.
at the moment. I don't know, I haven't looked at your shareholder listings I have to say, so I'm a little bit ignorant on this one. Is Saba on your shareholder register at the moment?
No, they're not on our register, and I think the way we would manage it, as I mentioned earlier, Jeremiah and I are we're just going to try to manage it the best way possible,
Yeah,
continue to drive that NAV, and hopefully let the chips fall where they may. But I think we're managing the trust in a very sensible, disciplined, way, and I think as stewards of the trust, our goal is to just do the best for shareholders, and it's a total NAV, and it's paying that proper progressive quarterly
yeah,
dividend. So
yeah.
that's how we're going to manage it, and sort of, look forward and not look around.
Yeah, no, it makes sense. You got to keep on with the
Yep.
day job.
Yep.
Keep moving. Got one from here. David says a slide suggested circa 5% in Canada. Do you view
Yep.
North America as a whole, or is Canada considered a risk factor?
Yeah, no, I think we would, so Canada's not in our benchmark, as you would imagine.
Hmm.
Um, we have two Canadian companies, so I may as well just talk about them because it's probably easier that way. But needless to say, the Canadian universe is it is the North American Income Trust. It's not the U.S. Income Trust. And 5% is generally where this trust has been historically. It's really two stocks. It's Restaurant Brands International, which is, you would know, Burger King. They own Tim Hortons, and Popeyes is a smaller arm of that. They also have Firehouse Subs, but a company that we've owned for 7 or 8 years, that we think
Hmm.
is very interesting here. We've made it a bigger position a year or two ago, turning a corner here with Burger King and Tim Hortons. So it's Canadian, but I would tell you it's sort of Canadian in name only. They have Tim Hortons is Canada centric. Burger King is U.S. and global. They just have a JV in China, so they're looking there as well. So very much a global type of name. And then Enbridge is a pipeline company, and it's a classic, name in this trust, that it's a toll taker type of model. So it's pipelines of oil and gas. And it goes all throughout North America. It is Canadian centric, but it is American. They also own a few American utilities in that. So roughly a quarter of their business is a utility business that is US centric. So it is Canada, but again, these are global entities where we
Yeah.
found value.
Okay, thank you. Question here from Janina. From a stock picking point of view, how have recent US regulatory and tax changes helped improve the income opportunity in North American equities?
Yeah, I think when we think about from the big news in America was this I mentioned earlier, sort of the expensing of capital expenditures and R&D. So companies have a big incentive now to invest, and what we've seen is some of that is in reshoring, and putting that incremental factory on U.S. soil. And we know that U.S. labor costs are high, which is generally why it's moved away in the first place. But what
Hmm.
we find is putting that on U.S. soil, there's a bit of more of a safety, less country risk, as we see in the last few years. And when the companies make these, they also invest in automation. We own an automation company called Emerson. So there's a little bit of that. But what you'll see is you just get more predictable cash flows at the end of the day, and more predictable cash flows tend to be more predictable dividends. So for us, that's generally how we see that linkage there.
Okay. Thank you, Fran. Looks like we're all out of questions at the moment. So unless anybody's going to type one away in the next few seconds, I'm just going to thank you very much for spending some time
Okay.
with us today, and wish you well over the next few months
Yeah.
as
Yeah.
maybe a few rocky rides come along your way. But I'm sure it
Yep.
sounds like you've got a pretty good grip of what's going on out there at the
Yep.
moment. So
Yep.
I'm sure you'll make some very good decisions in the process. Hopefully, grab a few cheap opportunities along the way. That's certainly what I'm thinking
Hey,
about.
our eyes are
But
always open, but yeah, no, thank you for the time, Michael, and thank you everyone for listening.
all
We
right, thank
appreciate your
you.
support.
All right, hope to see you again in a few months' time, maybe.
Great.
So
Hey,
take care.
take care.